we're seeing record physical deliveries on COMEX and shrinking LBMA inventories. To me, that looks more like sovereign accumulation than retail. As someone who's in the retail space, I would tell you I'm almost positive it is. And it seems like these traders certainly know the information. You now have Morgan Stanley moving away from a 60-40 stock bond allocation, as Wall Street has talked about forever, to a 60-20-20. Citing again, they expect sell half your bonds and buy gold. You have Michael Hartnett from Bank of America saying 25, 25, 25, 25. Stock, bond, short-term treasuries, gold. You got Jeffrey Gundlach saying 25% gold is not overweight. There's more and more clues out there from big money that seems to be now rethinking gold.
In recent weeks, gold and silver prices have experienced a healthy correction, one that has left retail investors uneasy, yet provided a quiet window for the most informed institutions to deepen their positions. While spot gold has retreated modestly from its highs, bullion demand from sovereign entities and central banks remains elevated. Silver, too, has mirrored this move, softening slightly on paper while inventories at major vaults continue to decline. Beneath the surface, the physical market remains tight, an indicator that the pullback may have far more to do with leverage-driven positioning in futures than with any meaningful shift in long-term fundamentals. This apparent divergence between market price and physical demand has become the defining feature of today's precious metals landscape. Institutional investors, from Wall Street banks to major asset managers, are beginning to pivot their strategies. Portfolio allocations once dominated by the traditional 60-40 stock-bond mix are being rebalanced to include significant gold exposure. As Andy Schectman points out, even mainstream voices like Morgan Stanley, Bank of America, and Jeffrey Gundlach are now positioning for a world where gold reclaims its central role as a store of value. For investors paying attention, this signals that the recent pullback may be less a cause for concern and more an opportunity to align with the flows of smart money. The underlying drivers of this shift extend beyond simple portfolio diversification. It reflects a broader recognition that monetary and fiscal imbalances in the U.S. have reached unsustainable levels. The dollar's strength, long treated as a badge of stability, is increasingly seen as a burden, undermining manufacturing competitiveness and amplifying structural debt pressures. These realities are pushing policymakers and private players alike toward a quiet recalibration of value, one that once again points to gold as the ultimate anchor of trust in the financial system. Stay tuned as Andy and Gold Silver's Alan Hibbard unpack this global repositioning, from the weakening of the US dollar and reshoring of manufacturing to the rise of private players like Tether that may be accelerating the dollar's decline. Their insights connect the dots between geopolitics, gold, and the evolving structure of the global monetary system. If you find value in deep data-backed conversations about the real forces shaping the gold and silver markets, don't forget to subscribe and stay with us till the end of this video. We appreciate the support and hope you enjoy the video.
I want to start with the big picture, Alan. A strong dollar makes exports expensive and U.S. labor uncompetitive. And I think if there's any nobility in maybe what Trump is trying to do is to reshore manufacturing. And with policymakers questioning King Dollar, that would have been the knucklehead Jared Bernstein dethroned King Dollar, and White House Vice President Vance writing on White House letterhead that Triffin's dilemma is actually a problem for the U.S. now because of the evisceration and hollowing out of the manufacturing base. And the Genius Act, tying stablecoins to treasuries for synthetic demand for the Treasury. My question to you, first question is, you think the U.S. is quietly tolerating or maybe even engineering a weaker dollar to possibly restore and reshore manufacturing?
Yes. The short answer is yes. I definitely think they're doing that because the incentives are such that they kind of have to. There's really no option. The dollar does need to be weaker, and this is part of Triffin's dilemma, and it also happens We see it with cryptocurrencies, which is kind of funny. There's that sort of tension about like, you issue all the coins to the founders, but then if you want anyone to use them, you have to sell them into the market, but that puts downward pressure and downward value on the coin. So there's that constant balancing act. The same thing happens domestically with a fiat currency. And of course, the same thing happens globally when you have the world reserve currency. So that's the Triffin dilemma. So yes, I do think there is a engineered plan to weaken the dollar relative to other fiat currencies. And of course, that means relative to gold and silver. So that's why we see the prices of those metals going up. We do see central banks acquiring gold like never before. And at a certain point, economics turns into an existential crisis for the government of a country. And the United States government is experiencing that right now. The economics on paper can work linearly for a while. And at a certain point, you hit that exponential tipping point. You hit a state change, like when you're boiling water, and the system itself changes. And we're getting very, very close to that right now. It can't go on too much longer. It's definitely an existential threat to have certain kinds of manufacturing inside our own borders. So they're definitely doing that.
Right. I think it's important to do so with AI taking 50% of entry-level jobs in the next few years, with 60% of the country with no college education. We don't make anything anymore. There is nobility in realizing that as a country, you must not be reliant on the world for your manufacturing. And I'm glad you see it that way. This has been something that's been on my mind for a very long time. And I think that also sets the stage for my next question, which is how private players may be reacting to this. And is there really this private entity, or is it commingled with the government? What I mean by that is Bo Hines, Trump's crypto czar until August, is now the CEO of USA Tether. And Tether is taking U.S. Treasury yield as being backing the new stablecoin in the Genius Act and converting it into gold and Bitcoin, the very assets that rise when the dollar weakens. Is this more diversification, or specifically, do you think Tether could be front-running and, in fact, let's just say accelerating the U.S. policy and in the process undermining confidence in the dollar to create this weakness in the dollar and perhaps even to have the dollar depreciate or devalue underneath rising Bitcoin and rising gold?
Yeah, it's a good question. And I haven't studied the mechanics of Tether so far that I would claim to be an expert at it. But what I can say is that in general, when you know that the dollar is going to get weaker over time, and it's a question of do we make it even weaker deliberately, or do we sort of let it take its own pace? There's a few ways you can react to that as a private player or as a competing government, for example. You can try to accelerate it yourself through various means, and it depends how large of a player you are. Or, if you want to catch butterflies, you don't build more nets, you build a garden and you let the butterflies come to you. So as a retail investor, if you imagine the smallest guy in the game, if you know that the dollar is going to get weaker, you can buy hard assets like gold, silver, or Bitcoin and just wait. And it will come to you. You don't have to do anything. You don't have to convince anybody. You don't have to write letters to Congress. You don't have to set policy. So I think there's a combination of many different actions that players are taking. In the case of Bo Hines, I honestly don't know, so I probably shouldn't speculate. But it almost ceases to be a meaningful distinction if Bo and Tether and whoever he's working with, if they know the future and they know that it's inevitable, they're taking a position, whether they're causing it or receiving it. It's almost less important than just stepping out and seeing what the trade is going to be. So I'm not sure, I guess, to answer your question.
Well, I think to your point, information is just as valuable as money. We're seeing and have been the central banks front run this gold run for the last 5 or 6 years. And kind of leads me to my next question. We're seeing record physical deliveries on COMEX and shrinking LBMA inventories. To me, that looks more like sovereign accumulation than retail. As someone who's in the retail space, I would tell you I'm almost positive it is. And it seems like these traders certainly know the information. You now have Morgan Stanley moving away from a 60-40 stock bond allocation, as Wall Street has talked about forever, to a 60-20-20. Citing again, they expect sell half your bonds and buy gold. You have Michael Hartnett from Bank of America saying 25, 25, 25, 25. Stock, bond, short-term treasuries, gold. You got Jeffrey Gundlach saying 25% gold is not overweight. There's more and more clues out there from big money that seems to be now rethinking gold, but the money that has been front-running this, the most well-informed traders in the world, seem to have known this was coming.
Following Andy's opening analysis, the discussion turns to the deeper economic and political incentives driving this realignment. Hibbard underscores how the United States, facing the limits of its fiscal and industrial policies, appears to be quietly engineering a weaker dollar to reshore production and restore competitiveness. In doing so, policymakers may be accepting a temporary decline in currency strength to achieve long-term sustainability, a trade-off that inevitably elevates gold's strategic importance. As the dollar softens, the value of real assets rises, and central banks' record gold purchases reinforce the idea that monetary trust is migrating from paper to physical reserves. From this perspective, the gold accumulation seen on COMEX and the LBMA is not random buying, but a coordinated repositioning of the world's financial architecture. Major institutions are responding to the same set of realities: persistent inflation, massive sovereign debt, and the growing consensus that traditional safe havens like bonds no longer serve their purpose. In this environment, gold, and to a lesser extent silver, offers not just a hedge, but a parallel system of value that retains credibility even as fiat structures strain under their own weight.
I guess my question to you is, with all of the record deliveries on COMEX, massive, and the shrinking inventories on the LBMA, you think this is part of a deliberate move to reshore and reprice gold, or even partially back treasuries and restore global trust, as Judy Shelton has told me twice now, once to me and once to Michelle McCory on this show, that on July 4th, 2026, she says, and has publicly been saying all along, that she believes Trump will tie the back end of the Treasury market to gold. What that would say to me is, yeah, you can bring back manufacturing with no upfront borrowing costs, where the redeemability is in gold in 20, 30, 50 years. She said they'll even make a 50-year with the Stablecoin Act running the front end of the market. Do you think gold is being reintegrated into the system here in the States? Possibly. And maybe even across the globe as a settlement system with the BRICS nations. Big question, but really what I'm saying is gold now transitioning into the monetary system by the massive inflows we see coming into the United States, or is it just simply arbitrage and tariff threat?
I think it's more of the former. I definitely think that we're headed towards a new monetary system. You had Secretary Scott Bessent say that, he used to have a fund. People would call him a gold bug. He loves gold, and he thinks that a new Bretton Woods is going to happen in the next 4 years, right? He said this right before Trump was elected, and he wants to be a part of that. So that's a new monetary system. He wants to be a part of it, and he likes gold. You also have Trump saying that, there's something nice about having the dollar backed by gold. I kind of like that idea. So, okay, fine. There's a lot of clues that suggest this. And to your point, Judy Shelton, I don't think she would be saying so confidently that Trump is going to issue gold-backed bonds if she didn't know more about that and if it wasn't being discussed, very, very seriously. So there's always a reason it may not happen, or maybe the timing is off. But I think we can take that as at least a very strong intention by the administration to move in this direction. And to me, that's sort of the key indicator, rather than the specific metric it takes or the specific date of launch. So yeah, if we see that, and then if we look globally at central banks, we've seen a sort of right sizing of the gold to GDP ratio of a lot of European nations. And this is over several years. So some nations are actually selling a little bit of gold if they have too much relative to a certain debt to GDP ratio. Others are accumulating. And so they're sort of lining up. It's kind of amazing. I learned about this through a Zero Hedge article a couple years ago. and it's continuing in that path. Of course, China is vacuuming up gold all over the world. It's not only the number one producer of gold, but also the number one importer of gold in the world. That's very unusual for a commodity. So, central banks are absolutely grabbing gold. They're right-sizing it. They're preparing for some type of new monetary system. And it's probably going to be backed by gold. It's not going to be silver. It's not going to be Bitcoin. It's going to be gold. And so whether we get that in 2026, I don't know. But what that signals to me is I got to get my gold ahead of time and then just wait for them to sort of, hash out the details. So pretty simple trade.
Yeah, I agree. I think, until the central bank stop buying, the bull run in gold is certainly alive. I agree with you completely and totally. You mentioned Bitcoin. One of the reasons that I'm so thrilled that Michelle Makori is here now is because one of the things that I have found particularly distasteful, regardless of my opinions on Bitcoin, is the constant divisiveness between the two camps, the mutual exclusivity. I admire that about you and Mike, in that I know Mike is someone who believes deeply in precious metals, but has an opened enough mind to look at the other side. I don't think you ever grow unless you listen to other people's viewpoints. I am not saying that I am someone who advocates for Bitcoin, but what I am saying is that the communities should be, I think, united rather than divided, as the message that we focus on is largely the same. In fact, I was looking at your X page, and there was one comment where you had commented on, the guy said, Bitcoiners know Bitcoin better than gold, and they know the reasons to own gold better than the gold bugs do. Now, I don't know that I agree with that or not, but what I'm saying is that largely we see the world through the same lens, choosing the vehicle, one that maybe focuses more on profit and the other on preservation. Well, to me, that sounds like a marriage made in heaven. I guess all I'm trying to say is that I think that it's a mistake to ignore Bitcoin every bit as much as I think it's a mistake to ignore gold and to poo-poo it. And I think learning from people like yourself about Bitcoin's role is important. One of the reasons I wanted to have you here and ask you, and I guess here is the big question. It's unequivocally known that Tether is stacking Bitcoin alongside gold. I signal out Tether because they're backing, largely they will back all Bitcoins with U.S. Treasuries. In fact, they're already compliant to the Genius Act, and in backing it with U.S. Treasuries, they get to keep the interest that is accumulated. They can't give that interest back to the stablecoin holder. With it, it appears as though, with the $8 billion in gold they have already and their attendance at the Beaver Creek Mining Summit, they're going right to the miners, and they're also buying Bitcoin. They own a lot of it. So to me, that feels like a signal. It's not just a hedge. And if sovereigns begin accumulating Bitcoin, we haven't seen a lot of that yet, but again, you got Senator Lummis from Wyoming who is advocating for this. In fact, revaluing gold next year, part of the executive order talks about revaluing gold, selling some of it off to buy Bitcoin. Regardless how people feel about Bitcoin, my question to you is, could it become a tool to recapitalize balance sheets or maybe even help offset the United States debt if companies like Tether are accumulating it through the synthetic demand accumulated through the movement of money on the Genius Act? Look at Bo Hines connected to this system. Could this all be part of recapitalizing or even paying off the $38 trillion in debt and the $175 trillion in unfunded liabilities?
As the conversation progresses, the implications become even clearer. The possibility of reintroducing gold into the U.S. monetary framework, discussed openly by figures such as Judy Shelton and echoed by members of the Trump administration, is no longer theoretical. The idea of partially backing treasuries with gold by 2026 or linking stablecoins to treasury yields and physical gold represents a fundamental evolution in financial engineering, one designed to restore faith in a system long dependent on expanding credit. If realized, such a policy could anchor U.S. debt issuance to a tangible asset, stabilizing long-term borrowing costs and signaling a return to monetary discipline. Central banks are recalibrating their gold to GDP ratios, aligning reserves to reflect a future where gold once again plays a formal role in settlement. China remains both the largest producer and importer of gold, a dual status that suggests preparation, not coincidence. European nations have been quietly right-sizing their holdings, and emerging economies continue to accumulate gold at a record pace. Together, these moves reflect a gradual transition toward a multipolar monetary order, one in which the BRICS nations and Western economies may converge on gold as the neutral asset bridging old and new systems. The integration of digital finance into this equation further complicates and enriches the narrative. As stablecoins and private entities like Tether back their issuance with U.S. treasuries, gold, and Bitcoin, a hybrid financial model is emerging. Whether intentionally or not, this model amplifies synthetic demand for both treasuries and tangible assets, potentially providing a mechanism for recapitalizing over-leveraged balance sheets. In a world burdened by $38 trillion in federal debt and over $175 trillion in unfunded liabilities, these dynamics could mark the beginning of an alternative pathway to debt stabilization. Ultimately, the steady march of central bank accumulation, the structural realignment of institutional portfolios, and the policy signals emanating from Washington all point in the same direction. The gold market's current volatility may disguise what is, in reality, a massive transfer of ownership from weak hands to strong ones. Whether through a new Bretton Woods framework, partial gold backing of treasuries, or the rise of asset-linked digital instruments, the global financial system is preparing for a recalibration of value anchored in tangible collateral. For the well-informed investor, the takeaway is unmistakable. This is not the end of gold's run. It's the groundwork for its next phase. Thank you for watching. If you found this analysis insightful, please like this video, share it with others following the gold and silver markets, and subscribe for more conversations that cut through the noise and uncover the real shifts shaping global finance.